Okay, we are recording. So I'm doing this lecture for chapter 2, which again, just like chapter 1, chapter 2, we really are not getting into any calculations yet. In chapter 2, we're discussing the conceptual framework. And that conceptual framework is, what is used to make all the information kind of cohesive, financial information cohesive, to be prepared using this conceptual framework helps to make the information more useful and more relevant. And in developing this conceptual framework, it helps accountants and other individuals come up with or solve problems that arise as we go through. So we'll kind of see this and talk about some of the different elements of the conceptual framework. And let me share my screen with you. Okay, so chapter 2, conceptual framework for financial reporting. And I just clicked on this little guy and I don't know. Okay, there we go. All right, so some of the learning objectives of this chapter. Again, we're not really getting into any calculations in chapter 2. We're really just looking at the framework and then the underlying assumptions and the principles within the framework. So describe the usefulness of the framework, understand the objective of financial reporting, identify qualitative characteristics of accounting information, define the basic elements of financial statements, describe the basic assumptions of accounting, explain the application of basic principles of accounting, and then describe the impact that the cost constraint has on reporting accounting information. So the need for conceptual framework, again, like we said, to develop a cohesive or a coherent set of standards and rules that all companies should follow, certainly all publicly traded companies that are required to follow these GAAP principles. And then also the framework helps to solve new and emerging practical problems using, again, that existing framework and the basic theories underlining that framework. So we've got 3 levels in the framework, and we're about to see, and I can't remember if it's the next slide or the next slide, but we're about to see the framework basically, and this is first shown in chapter 2 on page 40 of your textbook. So on page 40 of your textbook, it shows you this basic or the overview of the conceptual framework. And basically we have 3 levels. So the first level, or the bottom of the hierarchy, is our basic objective. Our basic objective of financial reporting is to provide financial information about the company or the reporting entity that is useful to present useful to present and potential equity investors, lenders, and other creditors in making decisions about providing resources to the entity. So again, financial reporting, the basic objective is to provide financial information about the company to interested users, right? Second level of the hierarchy, or second level of the framework, discusses the qualitative characteristics and elements. The qualitative characteristics being that of faithful representation and relevance, and the elements, again, going to the elements of the financial statements, assets, liabilities, income, things like that. Which again, we're going to see in depth as we continue through. The third level, recognition, measurement, and disclosure concepts. Again, these are the underlying principles and assumptions, and then the cost constraint of financial information. All right, so here's an example, or here is the conceptual framework and what that looks like. Again, looking down here at the bottom of the hierarchy, if you will, the first level, the purpose of accounting to provide information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in their capacity as capital providers. Because I mean, remember, like we heard in chapter 1, really this relates to the capital allocation process, right? Whether we're wanting to, we're a company, we're wanting to raise funds, we can do that by issuing stock, issuing bonds, taking out a loan. It all has to do with capital allocation, right? So that's kind of the first level. The second level, again, those qualitative characteristics, relevance, faithful representation, enhancing qualities. So those qualitative characteristics. And then the elements, we see 10 elements here. And these are elements to our financial statements. So assets, liabilities, equity. Of course, we know that those are found on the balance sheet. Equity, investment by owners, distribution to owners, comprehensive income, again, that's found on or has to do with the statement of stockholders' equity or statement of owners' equity. And then revenues, expenses, gains, and losses. Of course, these are elements of the income statement. So these are some of those elements that we'll be talking about as we're going through this. And then again, up at the top, the third level, the assumptions, principles, and cost constraints that we will discuss. So again, this is kind of just an overview of the conceptual framework, but as we go through the next few, or the rest of the PowerPoint, really, we'll be discussing each one of these more in depth. All right, so the first level, basic objective, again, to provide financial information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in making decisions about providing resources to the entity. So, again, as an investor, do we want to provide money as an investment to the company? Do we want to invest our money in the company? As a creditor or a lender, do we want to lend money to the company? As a bondholder, do we want to purchase a bond? Are we going to earn, a sufficient amount of interest? Is it worth our investment? So some of those questions that interested users ask, right? All right, the second level, the qualitative characteristics. Again, qualitative. When you talk about qualitative versus quantitative, so quantitative or quantitative data, for example, are data that, we're able to look at kind of the numbers, right? When we think about looking at revenues and expenses and net income, that's qualitative data, right? Quantitative data, right? The numbers, when we're looking at statistics, for example, or we're looking at the numbers on the financial statements, that's quantitative data, that's quantitative information. Qualitative, on the other hand, as it shows here, qualitative characteristics of accounting information is information that distinguishes more useful information from inferior or less useful information for decision-making purposes. So again, some of these qualitative characteristics involve relevance, faithful representation, this includes predictive value, confirmatory value, materiality, completeness, neutrality, free from error. And then some of the enhancing qualities, comparability, verifiability, timeliness, understandability, is what is kind of under the umbrella or in the realm of qualitative characteristics. All right, so we see that broke down here, again, relevance and faithful representation are the overall qualitative characteristics, as well as some of these enhancing qualities. So then when we think about relevance, then we can drill down on that: predictive value, confirmatory value, materiality, faithful representation. We can drill down on that to mean completeness, neutrality, free from error. And then again, these enhancing qualities is what makes the financial information relevant or of faithful representation: comparability, verifiability, timeliness, usefulness. So when we're thinking about information that is relevant, to have relevance, accounting information must be capable of making a difference in a decision. So, for example, if a company was looking into maybe purchasing a new asset, it would be relevant for us to look at what our level of debt is at this point, right? What liabilities do we have at this point? Can we afford to invest in this new asset, right? If we're thinking about, again, maybe investing in a piece of machinery for our factory, if we look at then, I don't know if we're thinking about investing in our factory, we're thinking about purchasing this asset. If then we looked at, okay, what do we have in our prepaid expense account? That'd be irrelevant to the decision, right? So we want the information to be relevant, right? And then again, that relevance breaks into predictive value, confirmatory value, materiality. So predictive value is if the information has value as an input to predict the future or what we expect to happen in the future. So if it has value as an input to predictive processes used by investors to form their own expectations about the future. So, to give you an example, if we look at Apple's financial statements and we say that Apple has increased revenue by 10% over the past 5 years. Year over year, over the past 5 years, they've increased revenue every year by 10%. Well, we can predict that revenue will probably increase by 10% in the subsequent year, right? Like, it has predictive value. Confirmatory value it relates to predictive value in as much as, okay, we can predict what happens, and then at the end of the year, we can confirm that's what actually happened. So along those same lines, using the example of revenue. So we look back at Apple's last 5 years or 10 years or whatever, and we say, okay, over the past 10 years, Apple has increased revenue year over year, by 10%, which it's actually larger than that. But we'll just say, for example purpose, 10%, right? So they've increased revenue. So we can predict that revenue will increase, 10% per year. But then when we get to the end of the year and Apple prepares and submits its financial statements, we can confirm that that's actually what happened, right? So, confirmatory value is when we're able to confirm our prior expectations. And then materiality in relation to relevance. Information is only relevant if it's material, I guess you could say. Well, and maybe that's given materiality too much credit. I mean, if you think about kind of the opposite of it, I guess, if information is immaterial, right? If information is not material, then it doesn't have much decision-making power, right? So materiality is defined different ways, and materiality is going to be different for every company depending on the size of the organization. But materiality commonly can be viewed as, for example, we could say that if something is 5% of a company's annual net income, that's a material amount. Or if something is, 10% of the company's revenues, that's a material amount. So, again, materiality is different for every company, every organization, but generally speaking, information is material if it can impact a decision maker's judgment or decision user information, interested users decision making, right? All right. Faithful representation. Faithful representation essentially just means that the numbers and descriptions in the financial information match what really existed or what actually happened in the business, right? So it represents what actually happened in the business. And then again, you drill down on that faithful representation and we come to completeness, neutrality, free from error. Completeness just being that all the information that is necessary for faithful representation is provided, so it's complete. Neutrality being that the company cannot select information to favor one set of interested parties over another. Financial statements should be prepared objectively, not subjectively, right? Like it shouldn't matter who the subject is, or it shouldn't matter the interested party. They're prepared objectively, right? And then of course, free from error kind of speaks for itself, that there are no errors or departures from generally accepted, or at least material departures from generally accepted accounting principles. And then from there, we move to these, again, enhancing qualities: comparability, verifiability, timeliness, understandability. Comparability, information that is measured and reported in a similar manner for different companies is considered comparable. So, again, when we think about the revenue recognition principle, we know that two American companies, for example, Apple and Microsoft, should be recognizing revenue in the same way, right? Because we've established that revenue recognition principle. It's a generally accepted accounting principle, and all publicly traded companies have to use that. So then when we're comparing those revenue of those two companies, then we can assume, right, that that revenue has been recognized according to that revenue recognition principle. It's comparable, right? Verifiability. Verifiability is when we're able to, through independent measures, using the same methods, obtain similar results. So, the company prepares its financial statements, and then at the end of the year, they have the auditors come in, and the auditors check the financial statements, and the auditors should be able to verify, using the same accounting principles, verify that all the numbers on the financial statements are correct, right? Verifiability. Timeliness relates to having information available to decision makers when it can still influence their decision, right? Before it loses its capacity to influence decision making. And then understandability. This has to do with a reasonably informed user can understand the financial information. So again, the average Joe Schmo, or whatever you want to say, the average person doesn't necessarily know how to read financial statements, but if it is a reasonably informed user, a reasonably informed user should be able to understand the financial information and what is being presented in the financial reports. All right, so we see that here. Again, those characteristics fall under relevance and faithful representation. The qualitative characteristics, we talked about each one of those already. And again, we see them here: predictive value, confirmatory value, materiality. We talked about each one of those already. And then faithful representation, again, completeness, neutrality, free from error. We talked about each one of those already. And then those enhancing qualities: comparability, verifiability, timeliness, understandability. Again, we've talked about each one of those already. All right, so the basic elements. So you'll notice on here we have 10 basic elements that are listed, and many of these I know that you've heard about already from principles of accounting. And again, now we're going to get more in depth into it, and we're going to talk about some of these different things. But assets, liabilities, equity, investment by owners, distribution to owners, comprehensive income, revenues, expenses, gains, losses. So I know from principles of accounting, we talk about assets, we talk about liabilities, we talk about equity, we talk about investment to owners, we talk about distribution to owners, right? Owners' drawings, owners' withdrawals. We do not, in principles of accounting, discuss comprehensive income, so that is a new one to you. Comprehensive income is the change in equity or the net assets of an entity during a period from transactions and other events and circumstances from non-owner sources. So it includes all changes in equity during a period except those resulting from investment by owners and distributions to owners. So comprehensive income. And then revenues, expenses. I know that we've talked about each of those in principles of accounting. However, we did not touch much on gains and losses. So gains are increases in equity from peripheral or incidental transactions of an entity. So not from normal day-to-day operations, but from peripheral transactions. So for example, if we sell, a piece of equipment, we could recognize a gain on that, or we could recognize a loss on that. So gains and losses are, result from peripheral or incidental transactions. Another example could be, if we purchase some type of financial investment and we want to sell it, we might recognize a gain on it if we sell it for more than what we had into it, or we might recognize a loss on it if we sell it for less than what we had invested into it. So those are kind of, the three new ones for us: comprehensive income, gains, and losses, that we'll be talking about more as we go through this textbook. All right, so the elements, that second level, those 10 elements that we just talked about. So just like it shows here, concept statement number 6 defines 10 interrelated elements that relate to measuring the performance and financial status of a business enterprise. So we have all prepared, or hopefully, I know at least most of you have because I had you for principles of accounting. We've all prepared the income statement, the statement of owner's equity, the balance sheet, right? So we know that when we're preparing the income statement and the statement of owner's equity, those financial statements are both for a period of time. Like if we are preparing those statements for the month of January, for example, the income statement and the statement of owner's equity for January would be, everything for period ended January 31st, right? So that'd be all the activities of that first period or that first month, period ending January 31st, right? So they're prepared income statement of owner's equity. They're compared for a period of time, a month or a quarter or a year, right? A period of time. Whereas the balance sheet, which the balance sheet includes assets, liabilities, equity, the balance sheet is prepared at a moment in time. So whereas with our income statement, our statement of owner's equity, we would say, for period ending January 31st, for our balance sheet, we would say as of January 31st, right? So income statement, statement of equity, those are for a period of time. Statement of cash flows too, a period of time. Whereas moment in time, that would be like our balance sheet, as of such and such date, right? That moment in time. All right, so the third level, recognition and measurement, it says FASB sets forth most of these concepts in its statement of financial accounting concepts, recognition and measurement in financial statements of business enterprises. So we've got some assumptions here, we've got some principles, and then we have the cost constraints. So as we go through the next few slides, we're going to talk about each one of these. I think you guys, I know that we've talked about at least a few of these in Principles of Accounting, but we're going to look at all of them here now. So the economic entity assumption just says, and this is also called the separate entity assumption, is the way I think it was worded in your Principles of Accounting textbook. But basically this just says that we have to keep entities separate from one another. So if you think about like a sole proprietorship, for example, you know, the sole proprietorship, the business is a separate entity from the owner, right? So we need to keep those things separate. We need to keep the personal expenditures of the owner separate and distinct from the business expenditures, for example, right? So we want to keep that activity separate, those separate entities, right? Or in the case where maybe someone owns, you know, I don't know, 2 different businesses, we would want to keep the expenditures of the one entity separate from the expenditures of the other entity, right? So that's the economic entity assumption. The going concern assumption, you know, the going concern is, you know, basically that we expect a company to continue to go, at least to satisfy it, you know, its obligations and commitments that it's had, right? So a company is going to last long enough to fulfill its objectives and its commitments. Monetary unit assumption, the monetary unit assumption, you know, states that companies need to prepare their financial information in the monetary unit of their domestic home country. So in the United States, of course, U.S. companies' financial statements are prepared in the U.S. dollar, right? But monetary unit is different for international companies. Like, for example, if a company is a European company, then their monetary unit is euros, or if a company is a Dutch company, then their monetary unit is the kroner. Or if a company is a Japanese company, their monetary unit is the yen. So companies have to prepare their financial information in the monetary unit of the domestic country that they're in, right? And then the periodicity assumption, this just says that we have to divide the economic life of a business into time periods. And this is really how often we're closing our books, really. I mean, if we are a company, and the company that I work for, we closed our books every month, right? So every month we were closing our books and preparing our financial statements. And those monthly financial statements then were compiled together to create annual financial statements at the end of the year, right? So we divide the economic life of a business into time periods. If it's a publicly traded corporation, they are required to submit their financial statements to the Securities and Exchange Commission on a quarterly and an annual basis. But many companies of significant size at least are going to probably do monthly interim statements as well to kind of gauge their performance on a monthly basis as well. All right, so the measurement principle, and this is where we get some differences in GAAP and IFRS, and we're gonna talk about this toward the end of the PowerPoint slide. But the measurement principle, or the cost principle, you know, generally speaking, says that we need to record the asset at what we paid for it, at the historical cost, right? What we paid for it. And this is true, again, under GAAP, generally accepted accounting principles. You know, this is certainly true for anything that would fall under like a fixed asset category, like property, plant, and equipment, for example. Whereas fair value measurement is more appropriate for financial instruments and, you know, receivables and things like that. So, you know, generally speaking, under GAAP, we use the historical cost concept, or the historical cost principle more often, but there are some instances where fair value measurement is allowed to be used as well. So, and we'll see that again as we go through the remainder of our book. All right, revenue recognition principle. I know we've talked about this before in Principles of Accounting. Revenue recognition principle just says that we have to record revenue when it's earned rather than when we actually receive the money from the customer. So this is why we have that accounts receivable account, right? We have to record the revenue when it's earned rather than when the customer actually pays us. So just to use a simple example, if we own a lawn care business, and we, we go out and maybe we have a contract to come and cut a customer's grass, 4 times a month. Once a week, we're going to go and cut grass. And then they send us a check once a month, right? Well, at the end of the month, say, what are we in now? It's July, right? I'm about to say January, but no, it's not freezing outside. We're in July, right? So we're in July, and maybe we cut their grass, the first week in July, the second week in July, the third week in July, the fourth week in July. We've cut their grass. We haven't received a check for them yet, but we're closing our books for July. We have to recognize that we earned that revenue. We have to record that revenue in July, even though they might not mail us a check or send us a check until August, right? So just like we've seen this journal entry several times before, we would, debit accounts receivable, credit revenue type thing, right? We're going to record the revenue even though we haven't received the payment yet. It's an accounts receivable, right? All right, the full disclosure principle. This just really states that any information that can affect an interested user's decision should be disclosed in the financial statement. So just like it shows here, providing information that is of sufficient importance to influence the judgment and decisions of an informed user. So, again, we disclose information in several ways, namely financial statements, notes to financial statements, supplementary information. And then some of the things that we could think about that, may not be shown in the financial statements, but that the company might want to disclose. Like, for example, if the company is involved in a large lawsuit and they think that it's, pretty reasonable to assume that they're going to have to pay out on that lawsuit, even though they don't know the amount yet, they would disclose that in the financial statements. That's something that might affect rather. That is something that might affect a user's decision making, right? Another example of something that has to be disclosed in the financial statements is like when there's a change in inventory valuation method, or if there's a change from, for example, using the historical cost measurement principle to the fair value measurement principle. So some of those different things, again, have to be disclosed in the financial statement. And then finally, cost constraints. So, you've probably heard the term before, cost benefit analysis, right? Like, we always have to recognize that there has to be a cost benefit analysis because, and what did I do here? Let me go back real quick. Oh, you know what? I forgot to mention this expense recognition principle. I was just looking, I'm like, hold on, I feel like I forgot something. So along the same lines as revenue recognition, expense recognition, we have to record expenses when they're incurred rather than when we pay for them. So I'll give you guys an example of this. And, I know it's been a long time since we talked about this in Principles of Accounting, but if we remember back to when we were doing our payroll entries and we did our payroll calculations and we did our payroll entries, and every month we took, federal income taxes out of the employees' paychecks, but then we only paid those federal income taxes into the United States Treasury every quarter. So expense recognition, we'd have to record those expenses every month that they were incurred, even though we weren't paying them till the end of the quarter. So, for example, we'd have to record the federal income tax in January. We'd have to record the federal income tax in February. We'd have to record the federal income tax in March. And then in April, we send a check for it, right? So we've got to record those expenses even though we haven't paid them yet, basically, if that makes sense. Okay. Sorry, I felt like I skipped something, so I wanted to go back. So again, we have to look at that cost benefit analysis. We have to determine if you know, providing the information, the cost of providing the information is less than the benefits derived from the information. So that's what it's showing here. The cost of providing information must be weighted against the benefits that can be derived from using it. So, you know, if it's something that's would constitute a large endeavor, and maybe, you know, costly endeavor that wouldn't make much of a difference as far as decision making, then we don't. If the cost does not, or excuse me, if the cost outweighs the benefits of it, right, then that's a cost constraint. So it gives us a couple of examples of it here. So it says, Raphael Corporation discloses fair value information on its loans because it already gathers this information internally. So because it already gathers this information internally, it's of little cost to also disclose that in the financial statements, right? I mean, it's already gathering the information. It's already incurring the cost internally. So there's no additional cost to then provide it to investors, right? There's no cost constraint in that case. In B, Willis Company does not disclose any information in notes to the financial statement unless the value of the information to users exceeds the expense of gathering it. Again, that cost benefit analysis. All right, so again, this is that conceptual framework, first level, second level, third level, and we've talked about each one of these before, and we will discuss these and do a couple exercises in class on these together as well. But something that you definitely see questions about on the CPA exam, within the CPA material. So definitely important to commit this to your memory and make sure you understand what each of these elements and what each of these characteristics and assumptions and principles, what each one of them means. All right, and then finally, as I mentioned, as we go through the chapters, I also like to point out kind of some of the differences in GAAP and IFRS related to the concepts in the chapter. So a couple of the similarities and differences. So GAAP versus IFRS. So financial information versus management performance. So whereas GAAP, generally accepted accounting principles, have been more focused on financial reporting and financial information, IFRS, the International Financial Reporting Standards, have been more focused. That conceptual framework gave more emphasis to the objective of providing information on management's performance. So whereas GAAP is focused objectively on the financial data, IFRS has tended to focus more on management performance, right? Historical cost versus fair market value. You know, although GAAP and IFRS are both increasing the use of fair value to report assets, IFRS fair value is used more often. So again, in GAAP, especially when we think about fixed assets, property, plant, and equipment, under GAAP, we would use the historical cost to value those things. But under IFRS, they use the fair market value more liberally, right? So companies under IFRS, companies can apply fair value to property, plant, and equipment, natural resources, and in some cases, intangible assets, where many of those things under GAAP, we would use historical cost. The monetary unit assumption, again, monetary unit assumption differs between GAAP and IFRS because in the United States, where we use GAAP, our monetary unit is the US dollars, whereas IFRS that represents a much broader global business community can include many different monetary units, right? We gave some examples earlier: the euro, the Dutch kroner, the Japanese yen. You know, so several different monetary units that are used under IFRS. And then finally, the conceptual framework element. So we just looked at the GAP conceptual framework, and remember we had those 10 elements under the GAP conceptual framework. Under IFRS only has 5 main elements. So under IFRS, and this is actually shown on page 75 of your textbook, but IFRS has assets, liabilities, equity, income, and expenses, right? Those are the only 5 elements included in the IFRS conceptual framework. So then we, GAP and IFRS differs a little bit there. So, all right, that is chapter 2. Again, we will highlight some of these things in class together. And get more practice with these things in class together. And I am going to stop sharing my screen. Hello, everyone. And okay, and that was chapter 2. And again, we will go over more of this together in class. And I will see you guys soon. Bye-bye.